In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll talk about how the company Gensol has been struggling because two credit rating agencies, ICRA and CARE, have downgraded its credit worthiness to D, which means default. And in the second story of the day, I'll do a bit of a deep dive into how TV is slowly dying as a video consumption medium in India and across the world. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Friday, the 7th of March. See, not very long ago, Gensol's name was associated with rapid growth in the solar power space. The company was designing and building solar power systems everywhere, from rooftops to large ground-mounted fields. It even ventured into electric vehicles by leasing EVs and announcing a plan to manufacture its own vehicles. Everything sort of sounded very promising. Its revenues also rose sharply and went from about 63 crore rupees in FY 2021 to nearly 1,385 crore rupees on a trailing 12-month basis. Now that is a massive jump by any standards. But recently, things took a bit of a negative turn. Two major credit rating agencies, CARE and ICRA, downgraded Gensol's credit rating all the way down to D, which basically stands for default. And this kind of rating means that the agencies believe that the company is struggling to repay its lenders on time. It does not always have to mean that there is no money at all. Sometimes it's also about late payments that keep on happening repeatedly. But the thing is, in the rating world, if you consistently delay payments, it is taken very seriously. And to make matters even more complicated here, ICRA said that Gensol had sent them documents in order to show that payments were made on time, but that these documents appeared to be falsified. And this raised questions around the company's corporate governance and whether there were any attempts to cover up actual delays. Gensol's management says that the problem is a short-term liquidity mismatch. And this basically means that they do have money coming in, but not necessarily at the moments that they need it at.
There has been zero wrongdoing as far as we are aware, and we will continue to work with high ethical standards. The committee has been formed so that this is independent and we can allege the allegation which has been made on us for document being wrongly provided, that can be independently verified. On the fact of was there a delay in the debt payment? Yes, there was a delay in the debt payment, but we have also repaid 230 crores of debt in the first 9 months. I am happy to provide through the stock exchange medium a complete breakup of all the debt that we have repaid in the first 9 months of the year, which aggregate to about 230 crores.
Now, to understand this simply, imagine that you cooked food for a large party and the person who hired you promised to pay at the end of the month. Meanwhile, your vegetable supplier wants the payment now. You know that the money is on the way for sure, but at present, you just cannot settle your supplier's bill. And that's basically how Gensol explains its delayed repayments to some of its lenders. Now, the company's bosses, including its chairman and managing director Anmol Singh Jaggi, are pointing to their large order book, which they claim is worth 7,000 crore rupees, and highlighting that they have already paid back over 230 crore rupees of debt in the past 9 months. They are also saying that to clear any doubts about this paperwork issue, they will set up an independent committee to find out what exactly happened here.
It is in the best corporate governance standards that independent committee does the audit of this rather than me or anybody else. So that's the purpose of forming a committee. So we want to do that.
Gensol's argument here is that they are a strong business that just needs to manage its cash flow a little bit better. But shareholders have been worried for multiple reasons here, and one of them is the pledge of shares by the promoters. Now, for those of you who are new to the markets, basically, if a company's promoters need money, they can hand over or basically pledge their shares to a bank or any other lender as a collateral for a loan. Now, in Gensol's case, a lot of its promoters' shares, which is over 80% of their stake, are pledged. And when a company's share price tumbles, and Gensol's share price has fallen by over 50% in recent times, lenders lenders who hold these pledged shares can actually ask for additional security to cover up for their losses. In the worst case scenario, they might even sell the pledged shares on the market in order to recover their own money. And that obviously can drive the share price down even further, which could create a sort of a vicious cycle for a company. But for now, Anmol Jaggi claims that the lenders have been given extra collaterals so that they do not dump Gensol's shares into the market. This will hopefully keep the share price from dropping little further. But there is also a bit of an odd detail here. The Enforcement Directorate, or the ED, which is a government agency in India that deals with money laundering and financial crimes, actually has a small stake in Gensol of about 1.34%. This stake was seized from some of Gensol's investors during an investigation, so it's now parked with the ED. To get out of this rough patch, Gensol says that it plans to reduce its debt by selling off certain assets, especially those related to its electric vehicles. It also wants to sell off one of its subsidiary companies for a decent sum of money, which the company can then use to either pay down more debt or to cover ongoing business needs. They believe that these moves will shrink the debt and will help the company reach a better debt to equity ratio. They're even talking about aiming for a zero net debt, though no one exactly knows what might exactly happen here. The promoters may also bring in fresh funds by buying shares directly from the company through something called warrants. Now, these warrants basically let them purchase shares at a certain price in the future. One more idea that they mentioned is that the promoters might buy shares from the open market, although that would mostly just be transferring shares from one person to another rather than giving Gensol new money. The positive spin here is that if promoters do start buying a lot of shares, it may help the share prices bounce back. In the eyes of credit rating agencies, if Gensol can actually show that it is making all of its payments on time for a few months and can also clear up the suspicion about false documentation, it might just get upgraded once again. Moving from a D rating to something better is definitely a big deal because it makes it easier to borrow money in the future at relatively lower interest rates. One more interesting point here is about how Gensol is linked to an electric taxi company called BlueSmart Mobility. Now, BlueSmart, for your context, is quite popular amongst EV taxi users, and it has also faced its own payment delays recently. Now, these two entities are very closely connected because Gensol is the one leasing a lot of cars to BlueSmart, and both these companies seem to be experiencing money troubles at about the exact same time, which adds a little more stress to everybody involved over here. Right now, though, it is very unclear if Gensol's problems are the beginning of a bigger storm or it is just a bit of a speed bump on the way. The company did grow very fast, which is quite impressive. It says that it wants to keep winning major solar and electric vehicle projects and that it is strong enough to handle these short-term difficulties. So its future definitely depends on how quickly it can pay back its debts, resolve any doubts about its paperwork, claim its lenders by stabilizing the share price, and continue securing new business deals without these repayment issues popping up once again. In the coming weeks and months, you will probably see a lot more updates about Gensol's share price, any planned sales of its subsidiaries, any new deals that it signs, and what rating agencies decide to do next. But for now, that is the situation. Gensol believes that it is all just a temporary setback and the management is promising that brighter days are ahead. With that, let's move on to the second story of the day. Recently, Bharti Airtel confirmed that they are in talks with the Tata Group to merge their direct-to-home or D2H television businesses, which is Airtel Digital TV and Tata Play. Now, this potential merger is valued at about 1.6 billion US dollars, and it would create a combined entity with about 35 million paying subscribers, which is more than half of India's pay TV DTH base. Now, I know at once this might sound like just one more corporate announcement, but the thing is, it actually tells us something very interesting, and it is something that you have probably seen coming for many years now. Television is probably slowly becoming a medium of the past. It is not irrelevant yet, to be honest, but the best days of the television seem to be behind it now. A variety of newer digital platforms are taking its place, from streaming giants like YouTube to OTT or over-the-top platforms like Netflix, Prime, and Jio Hotstar. And that is exactly what we'll dig into in detail in this story today. See, for many years, TV was the undisputed champion of the media space. Televisions were a craze even when they started as a black and white novelty item that entire neighborhoods gathered around and watched together. When they first entered India in the 1980s, only the government-run Doordarshan was on offer. The entry of cable TV in the 1990s flooded the media landscape with a variety of new shows and channels, often from across the world. And then DTH, or direct-to-home technology, entered the market, which offered direct satellite satellite broadcasts, and hundreds of channels all at the convenience of your home. And by the early 2000s, televisions had penetrated a majority of Indian households. They were now almost like a necessity. Anyone that could have a TV did have one in India. And this made television the emperor of advertising. It reached almost everybody, from big cities to tiny villages. Basically, if you could put your brand on television, in a single shot, you could sell it across the entire country. Individual channels held the key to entire customer segments of sorts. And with that sort of power, it was almost impossible to imagine that television could ever lose relevance. But the thing is, by the middle of the 2010s, a problem had started to emerge. While the television industry was more powerful than ever, its growth was actually slowly grinding to a halt. At nearly 70%, like I said, it seemed like televisions had reached as many households as they ever would. But meanwhile, a very serious challenger was emerging, which was the internet. Now, the internet, which was in its early days at that point in time, was a distinctly inferior alternative to television. But it was getting better and better by the year as technologies were improving and connectivities were getting better. Closer to the 2020s, there were two different types of video streaming platforms that emerged into the scene. First, OTT streaming services entered India and started to take off in popularity. They basically offered TV quality content but with more variety and choice. And second, YouTube picked up pace and slowly became one of the biggest video consumption platforms in India and also across the world. Now, YouTube allowed anyone to create content just like we do, and while a lot of it was not at the level of TV, the sheer variety that it offered was very overwhelming. But the interesting part here is that despite all of these shifts, TV still remains the main way Indians watch video content today. But the internet still has definitely been gaining ground. There were major moments of rupture such as Jio's rise or the COVID-19 pandemic, which have brought millions of new viewers to digital platforms, and many of whom have come at the expense of television today. According to TRAI, or the Telecom Regulatory Authority of India, over the last 5 years or so, the DTH subscriber base in India has been shrinking quite a bit. Between 2018 and 2024, it dropped from about 67.4 million to around 59.9 million. Revenues have also taken a big hit. Take just the last couple of years. Between FY 2022 and FY 2023, the combined revenue of India's four largest DTH companies fell from about 12,000 crore rupees to 11,000 crore rupees. And in FY 2024, it fell even further to a little over 10,000 crore rupees. Now, this is the context in which you should see the DTH merger of Airtel and Tata. See, traditional media heavyweights are sort of in a free fall and they are being forced to reinvent themselves in response to their digital challengers. So therefore, they are pooling in resources to deal with this crisis together rather than doing it in isolation. And what Airtel and Tata Play are doing now in the DTH space is not too different from what Vodafone and Idea did when Jio entered the telecom scene. Now, this drop in DTH is not really very surprising when you look at the way digital platforms have grown. See, over the last few years, for instance, the number of OTT subscribers in India has crossed 100 million people. And if you include YouTube in the picture here, the numbers become even bigger. YouTube now has nearly 500 million users in India, which makes us the country with the largest YouTube audience globally. And a very big reason for this is YouTube's sheer breadth. It is your music player, a kids cartoon channel, a cooking tutorial station, a classroom, a news platform, and everything else rolled into one single platform. But the thing is, while new age digital media is definitely gaining ground, the reality is that old school television still hangs on to its place in a lot of Indian households. According to BARC, which is the industry body that tracks TV audiences in India, TV still reaches more than 200 million households and almost 900 million individuals. And what's more important here is that it reaches them for much longer as compared to the other platforms. To give you a reference, the average daily view time for television is around 4 hours. OTT platforms clock only about 1 to 1.5 hours of daily viewing, and YouTube in comparison clocks only about 1 hour of daily average viewing. And that is also a big reason why TV still holds on to a decently large share of the advertising market. In 2024, for instance, TV contributed roughly 28% to India's advertising market. But on the other hand, if you want a quick comparison, digital contributed a much higher share of about 49 or 50%. But But a caveat to note here is that the TV industry's revenues from advertising have been quite flat over the last many years. So while TV has not completely been dethroned just yet, and people still do watch TV for long periods of time, the truth is that it is no longer a vibrant and a growing industry like it once used to be. Also, while TV is losing ground, something that we all must realize is that the bleeding is currently very concentrated at the top of the user pyramid. And if digital platforms do want to grow further, they must now move down to the middle and the bottom of the pyramid, where the propensity to pay in India at least is much, much lower. And this is where OTT players seem to be struggling quite a bit. They are still experimenting with a formula that can get them a wider audience base. A lot of them have launched ad-supported plans where subscription costs are relatively lower, and in exchange, users need to watch ads. Players like Netflix had to even slash its prices in India by up to 60% to appeal to a larger audience base after they faced roadblocks with its premium pricing model. And just like the DTH space, the OTT space too has seen some major consolidation in the market. One very big recent development, for instance, was Jio Cinema merging with Disney Plus Hotstar to form Jio Hotstar. Now, this move was valued at around 8.5 billion US dollars, and it ended up creating one of India's biggest streaming platforms. Meanwhile, the overall growth in India's OTT market, while is still positive, has slowed down compared to the explosion that it had seen in the pandemic days. In 2022, for instance, the viewership had surged by 20%, but by 2024, they had shrunk to around 13.8% in terms of growth figures. It is quite possible that digital media companies have already saturated their target users and are now struggling to go beyond that. So then that brings us to the question, what does all of this mean for India's media landscape? See, rather than digital platforms outright replacing television, what we are currently seeing is some sort of a stalemate between the two. TV is slowly losing relevance for sure, but it does retain its dominance. Digital media has grown substantially and has also eaten into the highest paying television viewers, but its growth is stagnating. It is possible that at least for a while, customers turn to both forms of media. Many people might be what industry experts call cord stackers rather than cord cutters. Basically, they could keep a TV subscription while also using OTT. And the proposed Airtel Tata merger is only one such latest move in this game. This move could definitely buy the television industry some sort of reprieve as it fights its battle for relevance. That brings us to the end of the two stories of the day. Let's now quickly move on to the final section, which is the quick news headlines. First, the Reserve Bank of India has announced liquidity measures worth 1.9 lakh crore rupees to address tight banking conditions ahead of FY 2025 closure. This includes 1 lakh crore rupees in open market operations through government bond purchases in two tranches of 50,000 crore rupees on March 12th and March 18th, alongside a 10 billion USD INR buy-sell swap auction with a 36-month tenor on March 24th. Second, Larsen & Toubro's Precision Engineering and Systems unit reported a 41% year-on-year revenue growth, reaching 4,610 crore rupees in FY 2024 as the company deepens its aerospace expansion. L&T, in partnership with Hindustan Aeronautics Limited or HAL, is assembling India's first privately built PSLV at its Coimbatore facility, with the launch now expected by mid-2025. Third and the final one, Jupiter Wagons Limited has entered the electric commercial vehicle market with the launch of JEM Tez, which is a 1.1-ton electric truck priced at 10.35 lakh rupees. The company sees a significant opportunity in the 4 lakh unit annual small commercial vehicle or SCV market, estimating that 25 to 30% EV adoption could create a 1 lakh unit demand. That's all the news and stories I have for you today. I hope you enjoyed this show and maybe learned something new from it today. This is your host Anurag Bansal signing off. I'll see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.